Good morning, currency traders. Let's do our Forex daily Forex trading strategy session. Today we'll cover how about dollar pairs, yen pairs, gold and oil. We can also look through the currency indices. And then as I promised, 3, 4, 5 days ago, that we would review, and I suppose I'll have to teach, the commitment of traders report on Forex.Today. So I'll do that. So I think it's going to be a full, fun, and fascinating Monday morning. So let's go! Bum, bum, bum. So again, Forex traders, we'll do the commitment to traders report. Let me know, first of all, if you are new to the commitment of traders report. Type in like COT new. But anyways, hey, my name is Wayne McDonald. I'm the Chief FX Market Strategist for TradersWay.com. We're bringing this webinar to you live from the Forex.Today YouTube channel. Please subscribe and like. Also, if you're a subscriber and you're not getting the notifications from YouTube on a consistent basis, then please visit twitter.com/FXBootcamp. Or am I supposed to say @FXBootcamp? But anyways, go there and you're notified instantly. So if you prefer that way, that's how you do it. I've been trading currencies for a very long time. I've been trading currencies in front of people since 2004. So I've been around. I know a few things. So please get involved, ask questions. I'm happy to help. So again, by request, I will be covering the Commitment of Traders report found at Forex.Today. And then we'll try to get in everything else, right? All the biggies, the dogs, the big dogs, the dirty dogs, dollar, oil, gold, and stuff. So only one new. 2, 3, 4 people new. Oh, okay, there we go. Up, let me scroll. No. Okay. Cool. So a few people new. All right, well, that's why I'm here, to help those that need the help. Well, I hope you had a wonderful weekend. I was a little bit blue for some reason. Not really sure. Happens, I guess, right? But I'm better now. So, all right, cool. So I guess we'll just start here because I don't want to forget. Okay, so go to Forex.Today and you can click on COT report. Bum, 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 bum. Okay, what, pray tell, is a commitment to traders report? First of all, I need my drawing tool. La da 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 ba da da ba da 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 da. Whoa oh 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 oh. Hang on. I guess that's booting up. Let me bring the site back. There we go. All right. I guess we got to do that, and then I need to bring up the website. Come on, Wayne. There we go. Where did Travis says I got the Fogbuster coffee? Where? Like the Harvard stuff? Global Investor says, when I open a new account to Traders Way, which commission structure should I do? You know what? I have always preferred variable spread. To me, it catches everything. I've never been an ECN guy, probably because I was a professional trader first and foremost, and that there's value in having spread. Let's just put it that way. There's there's hard dollars and there's soft dollars and all that kind of stuff. So I'm trained to like variable. And of course, variable, I always get the best spread in the moment. Fixed spread, you always know what you're going to get. So if you're going to scalp heavy news events when spreads widen, well, then that's what you should probably do. But I do that very, very less often than I used to. And then, ECN, I don't like paying commission, so I'm okay with the spread and all that kind of stuff. So whatever. Travis said it's actually 5 different coffees roasted 3 different ways. Made in the same town it's a Harvard thing. So I don't know where they get it, Travis. Okay. But the last 3 summers I lived in the houses, every house had this fog buster. So it's a Harvard thing as far as I know. And Harvard's really cool. They source everything for themselves. So like if it's seafood day, in the kitchen, right? There's no cafeteria at Harvard, which is really cool. So every house has its own kitchen staff. And so when it's like fish of the day, it's really cool because they have a poster and it shows the fisherman that morning, like literally the guy and his crew on the boat, and that's them bringing in the fish that you're eating. It's really cool. So I don't think they would, get some random stuff. But anyways, let's move it. Yeah, the Harvard kids have it tough, right? All right. Hopefully everyone can see this. You know what? Let's zoom in a little more. Let's try this. Oh, Ed, they don't have stock indices. No Dixie, sorry. Or in that case, a currency indice. All right. Let's move it around here. Can you see that okay? All right, so we're at the Commitment of Traders report. This is a neat little thing. Now, first of all, it's released Friday at the end of trading. Okay? It's released at the end of Friday. That's when it's available. So this is the newest report. This came out on Friday. I know it's not Monday, but it came out Friday at 4 p.m., I think. And the government releases it. In fact, it's the CFTC, the Commodity Trading Futures Commission. And what they do this for a very particular reason. This goes back to the days long ago where the market from time to time would have massive imbalances. For example, like right now, probably everyone is buying yen, right? You can get to the point where what if no one is selling yen anymore, right? The market can get very topsy-turvy, and that can be disastrous because the market can collapse, right? So anyways, it's very useful for people to have this information. Now, this started with commodities, obviously. The Commodities Futures Trading Commission, CFTC, was in charge of this. And so this had to do with things like, wheat and iron ore and gold and this kind of stuff. And then over the years has moved into more financial products like currencies and such. But it's gathered by the Commodities Futures Trading Commission. And they do this in a very interesting way. The first step is they say there are bona fide hedgers in the market, right? These are companies that are buying and selling commodities, not because they want to make money trading futures contracts, but they're hedging their cash position. So for example, and by the way, this is right out of the Series 3. I don't know if you plan on taking the Series 3 exam by the NFA, but the Series 3 questions can go like this. So here's a basic one. They say you're a grain elevator operator and you have purchased $1 billion in wheat from a farmer, but you're worried over the next 3 months that prices of wheat will fall. because now they've paid the cash, so they're short cash, and they're long wheat because they own the wheat and they gave up the cash, right? So they say you're short cash, you're long wheat. So now they're actually holding the wheat, and they hold it in storage, and they're waiting for the day to grind it into flour and then sell the flour to somebody. Well, what if wheat prices fall during that period? Well, that's a big risk for the $1 billion invested, right? So they can go to the futures market, and then they can short sell wheat contracts. And the reason they short sell it, first of all, they're leveraged. So for $1 billion, I think they're leveraged 40 to 1. So you need just a small fraction of your cash position. You can short, and what that means is if wheat prices fall, you make money. But remember, the value of your physical wheat in a storage bin in your elevator has lost value. The street value of wheat has fallen, so you've lost money on your physical, right? But you're making money on the futures contract. And you're like, so what's the net? Basically zero. You haven't lost anything. And that's a hedge. So the government says, okay, cool. We see there's lots of people buying wheat and there's lots of people selling wheat. Now, how do they know that? Well, commodities are traded through an exchange. So let's just say the Chicago Board of Trade. And by the way, I've stood on the floor at the Chicago Board of Trade. Very, very cool experience. I don't know if it exists anymore. I am super lucky to have done it. I've been to the S&P 500 trading pit. I've been to the 10-year T-note trading pit. When you walk onto the first floor, you're in soybean meal futures pit. And you're like, oh my God, I'm in the soybean meal futures pit. And then they say, hey, look to your left, bro. The other room is 10 times bigger. And you look and you're like, oh my God, it's so big. It's amazing. So anyways, it's all traded through trading pits. So if you buy something, you sell something, it gets recorded by the exchange. Cool. So the exchange reports how many contracts are out there, long and short. Also, the next step is very interesting because the government wants the traders to report as well. So they look at it, and like I said, they start with the bona fide hedgers. Because if you're in the market, but you're not trying to make money, you're only trying to hedge your position, well, you're in the market, but you're not a speculator. So they had this ingenious idea. They said, okay, we won't tax them for profits or loss. Because what if you make money in the futures contract? Well, you lost money in the cash position. Well, what if you made money in the cash position? Well, then you've lost money in the futures contract because you shorted and prices went up. So you're making money on your cash position, but your futures contract has lost money. So you know what I mean? So the government says, cool, we're not going to tax you on profit or loss if you're a bona fide hedger. So they say, if you're a large institutional market participant, you must report to us. Right? Then the second thing they say, if you're a bona fide hedger, we won't tax you on your profits and losses. So you have to report to us that as a market participant, you are only hedging. So you might be like RJ Nabisco or something. Your company might make cereal, right? Or right, that kind of stuff. So anyways, this is ingenious because there's a tax incentive to report. By the way, I look like I'm slouching, right? Let's do this. All right, so there's a tax incentive. So they go, ha-ha, now we know who the hedgers are. So get this. They look at all the volume from the large institutional investors. They know who the hedgers are. Now, all large institutional investors, this is, if you're holding like 100 contracts or more, right? Something like that. They all report. They report on Tuesdays. So bona fide hedgers report on Tuesday, and bona fide speculators, those that are in the market to make money. Well, right? Because they are in the market, they are reporting because they have large positions. but they're not bona fide hedgers. You see the genius part of that? They're reporting because they're large investors, but they're also not hedgers. Ha ha ha! What a neat system. So now we can separate these market participants. There's a large group that are hedging, large group that are speculating. Nice. But then here's the next thing. You look at the total volume of trading over the exchange. And you say, okay, yep, there's all our hedgers. Yep, there's our speculators. But it doesn't equal 100% of trading volume. It's most, maybe it's 90%, but there's this leftover junk of volume of trading, contracts bought and sold every day, right? So you could say like 45% of it is hedgers, 52% are speculators, and then there's like this other. What's the other? Non-institutional investors. Dumb money, retail scum like us. We're retail scum. Okay? Because we know who the bona fide hedgers are, we know who the large institutional speculators are, and then there's leftover junk. They're not reporting, but the exchange says, well, there's trading volume that's not accounted for by large institutional speculators and large institutional hedgers. And the leftover is us. So now we have 100% of the trading volume accounted for. Thank you, CFTC. So every Tuesday, because Monday is too difficult, plus Mondays there's holidays, and Mondays there's meetings. So they say, hey, at the end of trading on Tuesday, if you're a large institutional investor with large positions, you must report it to the CFTC by 4 p.m. That gets gathered, calculated, and all that, and that gets released on Friday. You get it? It's neat, right? They gather it Tuesday at close, so the government gets together on Wednesday morning, probably 10:45, right, after they do their morning socialist exercises. And then what? They work at the fast pace of 5 minutes worth of work per hour, and then by Friday, they're like, we gathered all that data and put it in a spreadsheet. Nice job, guys. And they report it Friday after trading. So really, your first opportunity to look at this is over the weekend or Monday morning. Okay? So what good is this? Well, we can learn a lot of things. And let me give you an example, and I'll draw the example here. There about, I don't know if it was a year ago or 2 years ago, there was a steady trend. The euro, let's bold this up, man. I'm feeling bold this morning, okay? The euro USD looked like this for about 2 months. Is that bullish or bearish? Two months, it did that. Up, down, down. Up, down, down. Up, down, down. Up, down, down. Up. Well, the very, 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 very interesting thing is that the COT doesn't just break the market into pieces like institutional investors, non-institutional investors, retail scum, but they also separate it because these are contracts. They report, are they buying contracts or are they short contracts, right? They're long or short is really what I should say, okay? So they can also report and do also report long contracts and short contracts. So now we know the number of traders long and the number of traders, not numbers of traders really, numbers of contracts, okay? Long or short. Now here's the funny thing. The number of long trades stayed steady. I'll just make up a number at 1,000 contracts a week after week after week after week. It went up a little bit, it went down a little bit, but basically, right? K is contract. 1,000 long over and over and over, week after week after week. Nothing really changed. And if it changed, it didn't change by much. But how about this? The short contracts starting here went from, let's say, 1,000 to 900, and then 850, and then 822, and then 799, and 787, and 752, right? 717. 692. What's happening? The number of open contracts that are short contracts, the number of short contracts in the market is falling. No one's buying here. Buyers have already bought, okay? These are open, not new contracts, open contracts. So like those who want to be long are long, and it's not changing, but the number of people that are in the market to be short, there's less and 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 less. So here, let me blow you away. Here's what we watched. Oops, I guess I have to redo it. We watched the COT. You know what, I'll just tell you. So we watched the COT for weeks, and it did this, months actually. And no one was buying. Not in the futures contracts. Okay? Oh, hey, Barry, I got your email. I can't do that. I have liabilities for such things like that. I cannot do that. I'm sorry, bro. So anyway, so we watched and watched. The number of contracts was not going up. We were just losing bears. So the thing is, if the market was heavily bearish in the past to get the market down here, and then it started going up, but we don't have bears, what happens when we get to hardcore resistance? Well, the bears are going to want to sell again. Right? Because they sold before and made money, so now they're waiting for this next move. Probably on a higher time frame we're used to, because each one of these little dots is a week. There's 1 week. There's 2 weeks. There's 3 weeks. There's 4 weeks. So we're talking about, traders that are in the market for months, not minutes, right? So for that period of time, no one was buying, but everyone was getting out, and the euro dollar was going up. So the logic is, at some point, they're going to want to short again, because if there are no new bulls in the market, yet the market is going up, the reason it's going up is we're just losing bears. Well, if the bears come back to the market, it will fall again. It's very amazing stuff, right? So it's really useful on a trend basis. So check this out. I am going to highlight this right now. See, in light gray, long contracts. Now, in this one, I've stripped out the retail people. Well, there is no retail people, right? By the way, you can download this COT data from the CFTC website. I think it's cftc.gov. You can download it, but it comes out as a spreadsheet. Okay? This is very, very helpful. Thank you, Forex.Today. This is very helpful. And some services that charge you money, they will add retail back into it because it's just 100 minus the other two, and then they add that back. So I cut out the retail stuff, right? And this cuts out hedging. So this is just large institutional speculators like you and me. Okay, so the first thing I look at is long. How many are long? So let's do this in a thick gray. Okay, these are numbers of long contracts for euro dollar. Well, actually euro, because it's American exchange, euro priced in dollars, euro dollar. Okay, that's the gray one. So how dramatically has the number of long contracts changed in the last couple of years? How dramatic has the change of long open contracts changed? Forex.Today, yeah, Forex.Today. This is it. Forex.Today, guys. Hello. So I guess it's either a lag or I'm asking too obvious of a question. Hardly any change in the number of euro bulls. This is euro priced in dollars, guys. Euro contracts, euro futures contracts. Okay? So you could say there's basically no buyers in the market, no new buyers, or very little buying interest. Okay, now in this color, it's a sort of a bluish color. So let me delete that. Let's put it back in our typical blue. Okay. All right, so now we're looking at, oops. Okay, this. And this one's hard for me to see with the lights on. Okay. This is short positions. And these were long. You should always label your charts. So we'll call this long and we'll call this short. Okay, sorry, Harvard habit. All right. Has there been changes in the number of bears over the period of time? Well, back here it was fairly neutral. Then there were more bears. Then sort of tapered off. And then more bears. And then more bears. And then somewhere around here, less bears. And then somewhere around here, more bears. So let's put this in yet another color. How does it affect the euro dollar price? So again, these are the number of bears. So this blue line going up means more bears, not higher prices. It means more bears. Down means less bears, but they actually bought contracts that are short. That's where people get mixed up, like they bought it to sell. Yeah, it's just you buy a contract that says if prices go down, you make money. Okay, so anyways, they're short. So let's check this out. I am now going to highlight price with this blue. Here's euro dollar price. We'll start here. Okay. You see around here, there starts to be a divergence, right? The number of bears are going up. Number of bulls are not going up. So the net change would be more down than up, right? In price. So check this out. This is price. Okay. And then we get about here and you see how it goes flat for like 6 months. No new bulls, no new bears. What happens to the price? It drifts around. And then right about here, the number of bears goes up. Number of bulls, no change. So that means prices get pushed down, and prices get pushed down, and prices get pushed down, and prices get pushed down. And then somewhere around here, it levels off, and then the number of bears falls. Number of bulls, no real major change. And check it out. Price, stops falling. In fact, price rises. Okay. And then what? Around here, bears start to re-enter again. So price starts to fall. Oh, snap! Isn't that interesting? And then to add one more color, there's a net. So you can look at one line and say, it's the number of longs minus the number of shorts. Okay? So oops, I just killed everything. So long minus shorts equals net. Okay? And so you can look at this black line, and this is the most important one. More bears, 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 more bears. Oh, no, sorry. Yeah. Well, this is actually, I shouldn't say less bears. We need to look at the net to actually figure out what's happening, because it could be different numbers here. So it's more bearish, more bearish, more bearish, right? Okay. Neat, right? Euro falling, euro rising. So the question is, we've been watching euro rise the last while. Okay? Remember this? Let's go back to what we're talking about. Over the last, 3 weeks? Maybe 4 weeks? The euro's gotten strong. Why is that, how is that happening? Why is it happening? There's a slight increase in bulls, a more dramatic increase of less bears. There's some buying, and there's also some exiting. So it's a wishy-washy trend. So let's look at the longs minus the shorts. What's the net over the last couple of months? Not dramatically different. Isn't that neat? Has someone reminded me to look at? No, I remembered myself. Thank you, Simon. Isn't that neat? So it's moderately bullish, but not dramatically bullish. Saying that the people are buying the euro doesn't fully explain the market. Lots of people were short the euro and they left the market. But the thing is it possible they come back to the market? So let's re-highlight. This is what they were doing. Okay. Is it possible they come back to the market? Oh, yeah. Okay. So what we want to see, let's say you want to short euro dollar. What are we looking for? We want to see this line down, this line up, okay, and prices falling. Okay. So if you see that there's some buying and even more exiting, it's more less bearish. Okay. These guys might be in it for the short haul. I'm trying to get it. Okay. These guys might just be in it for a quick buck. These guys might have been short euro for years. So when they get back to a reasonable level of resistance, they might sell again, which means actually this goes up, actually, is what it would look like. Okay, the number of contracts may go up if they start selling again. Okay, isn't that neat? So you can start to analyze why markets are going up. Okay, and now if you go here, you can change your currency and take a look at CAD, and you could look at pound, and you could look at yen, and you could look at, I think Aussie's in there. Okay. Compliments of Forex.Today. Well, John T., these are futures contracts in America. So if you're on the, I don't know, so if you're on whatever exchange, so I don't think currencies are done on CBOT, but if you're at the Chicago Board of Trade and you're buying and selling wheat, what currency is it in? Dollars. You're in Chicago. So if you are, instead of buying and selling futures contracts on wheat because you're worried about wheat prices going up or down, well, what about if you do lots of business in Europe and you're an American company and you're worried about the value of the euro either going up or down? Well, then you're going to start buying futures contracts on the Chicago Board of Trade. And again, I don't think they're actually done at CBOT, so I forget which one. Is it New York? I don't think it's New York. But anyways, whatever exchange you're at, you buy either a long futures contract or you buy a short futures contract for euro, but of course it's priced in dollars. So by definition, it is dollars. Okay. Okay. Same as any other asset, you could hedge the price of wheat, but in dollars. Okay, whatever. So I think you get it. Cool, right? So this is available to you for free. By the way, there was a time, maybe a year, I used to pay something like $150 a month to get a chart like this. I'm not joking. And that's like one of the nicest ones I've ever worked with. And I am not joking. I'm not hyping that up. That is one of the nicest commitment of traders reports I've ever worked with. Better than the one I paid $150 a month for. So anyways, you go to Forex.Today and then you click on COT. Okay, pretty cool, right? And of course, we got a calendar for you if you want that. La, la, la. So we're here, so let's go through the week, huh? So this week, great. I want to get rid of medium impacting news events. So here's what we need to know. So tomorrow, some Euro news. Great. Okay, like they have inflation. Not. Unemployment rate in England. Nice. And then zoo out of Germany, basically, right? So beautiful stuff right in here. I think UK is going to be most interesting because we're trying to figure out the impact of Brexit and no Brexit and yet another vote Brexit on the economy and in particular on jobs. Because the worst case scenario is you have high inflation because your currency is falling and then people lose jobs because the economy sucks. Right? So you have capital flight weakening your currency, and then people start losing their jobs. So prices are going up, but people don't have any money. That is the worst. That reminds me of like Argentina. By the way, good job on the election, Argentina. Don't cry for me. So they had an election, and they, I guess, maybe knew changing government, which means more uncertainty. Maybe capital control is coming back to Argentina, which means all the suffering they've done the last few years will be thrown out the window and blah, 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 blah. Good luck, Argentina. It's going to be another tough decade. I think, so you might laugh at like Turkey having 25% interest rates. I think they're like 50% in Argentina. If you lend Argentina money, they'll pay you 50% a year. You should leverage that up, right? Sarah says, hey, Wayne, just a little question. Do you only trade Forex or are you into stocks too? I love trading almost anything, to be honest with you. So I've traded stock individual stocks. I've traded stock futures and like stock indices, mostly Dow, DAX, S&P 500, Nikkei. That'd probably be it over the years. Of course, I love commodities, so I've done gold and oil, but then a bunch of other random commodities over the years. They each have their own seasonality and cyclicality. So you got to really know what's going on there. And there's some other tools that you can use for all that. But what I found, because one year I got my tax filing was, I'm not joking, it was hundreds of pages. And it cost me, I think it was like $20,000 to do my taxes. And I'm like, holy snap. Why is it so complicated? And so my tax team that year said, well, you traded, individual stocks. There's a tax treatment for that. You traded stock futures, and there's tax treatment from that. You traded Forex, there's tax treatment for that. You traded this other thing, and then you traded this other thing. And they all had different tax treatments. So they all had different formulas and different calculations and different tax rates. And was I leveraged? Was it cash? Was it this? Was it that? Was it international? Was it domestic? And I am not joking. It took, we filed in November. Not my taxes, but the fee the tax firm charged me to do my taxes was 20 grand. And I'm just like, oh, snap. Okay, snap. And then because I'm born and raised, so to speak, as a currency trader, I said, well, I can trade the S&P 500, let's say, through euro yen. Back there, they had a high correlation. I can trade gold through Aussie dollar or through ZAR. I can trade oil through the Canadian dollar. I can do this through that, right? And from that point on, I kept watching all the charts, but if I saw DAX on the move, I would trade euro because it's related. Right? If I saw FTSE on the move, I'd trade pound, right? If the stock markets were having a bad day around the world, I'd buy Japanese yen. I wouldn't sell Nikkei. I wouldn't sell DAX. I wouldn't sell FTSE. I wouldn't sell S&P 500 like I used to. I would just buy the Japanese yen. So I started trading those moves through currency correlation. And my taxes went from taking 9 months to do my taxes to now only 3 months to do my taxes. But the complication went away, right? Okay. Max, there's no FIFO. As far as I know, there's no FIFO. I don't know why you'd want FIFO. Okay, so anyways, that's why to Sarah that asked. So now if I'll trade anything and I'll trade everything. But the best way to do it is through Forex. Now, here's a couple other reasons why Forex is far superior. I'm leveraged. In the United States, maximum leverage is 50 to 1. Futures is only 40 to 1. Outside the United States, you can get 100 to 1. You might even get 200 to 1 if you need it. Maybe if you don't have any money, that might be important. But I can get more leverage, right? Also, if I'm long the S&P 500 futures contract, right? I don't mean actually owning the stock, the futures contract. It will go up and down in value as the underlying asset goes up and down in value. But if I own the 500 stocks of the S&P 500, they would pay me dividends, right? Do I get dividends if I own the futures contract? No. It's a derivative. It derives from the underlying asset of the stock index. And the stock index itself is a derivative. It isn't owning the 500. It's tied to the 500 companies. And by the way, there isn't even 500 companies in the S&P 500. But if you were like an ETF fund manager and you went out and you bought stock in every single company listed on the S&P 500, those that pay dividends, and many do, would pay you dividends. But if you own the S&P 500 futures contract or the index, you don't get paid the stock dividends, okay? So let's go all the way back to Forex. So let's say, I'll just make up a number. Let's say Aussie yen, 87% of the time goes up when the S&P 500 goes up. Okay? That's cool, right? 87% of the time. Not always, but it has a high positive correlation for you statisticians. So you could buy it, and almost always, if the S&P 500 goes up, let's say that Aussie yen goes up too. Cool. So now I get exposed when I see the S&P 500 starting to turn north. Then I look at Aussie yen starting to turn north. I buy it. But here's the thing. I get paid the yield. So right now, Australia doesn't have a yield, but traditionally it does have a yield. Traditionally, I would guess 3-4% yield differential, which means, let's put this in numbers. Let's say I got paid 6% by the Aussies. No, they don't. This is way down now. I'm talking about in the past, normally. But anyways, let's say Aussie paid you 6% and yen cost you 1%. Okay. Let's dumb this down. You guys are probably laughing. You can't even imagine Aussie paying that much. All right, so let's do it this way. Let's do 3%, okay? And this one cost me 1%. So the differential is 3% minus 1% equals 2%. So if I'm long Aussie and I'm paying for a loan, it cost me 1%, well, my profit now is 2%. So why is this important? Well, first of all, remember, if you just bought S&P 500 stock index, you are nothing on the way up or down because you're not collecting dividends. Well, if 87% of the time Aussie yen goes up as S&P 500 goes up, or Aussie yen goes down as S&P 500 goes down, then I'm basically trading the S&P 500 through the Aussie. I'm leveraged, so I'm collecting 3% on my leveraged money, but I have to pay for the leverage, which is 1%. So I'm clearing 2% profit, not on the value of the Aussie dollar going up, on the interest rate differential, which I get paid every day. So that's 2% a year, like any other loan, right? That I'm collecting on Aussie yen, which is kind of like a dividend. But am I leveraged 10 to 1? If so, I'm collecting 20% a year. Am I leveraged 50 to 1 in the United States, maximum leverage? Well, then I'm earning 100% on interest payments, which is a heck of a lot better than the dividends you'd be collecting if you wanted to buy the S&P 500. And then instead of buying the S&P 500 stock index, you bought every single S&P, or bought an ETF that owned every single, and then you collected the dividend somehow that way, right? And of course, if you're leveraged 100 to 1, you're earning 200% a year yield. Okay, so like, right? So anyways. So how do we say this? So if you had one standard contract and it cost you $1,000 of your actual money, you're going to collect $2,000 a year in interest, plus, obviously, pips. What are pips? Simply the appreciation or depreciation, right, of the asset you invested in, not down to the penny, but down to the 100th of a penny. Okay. Sarah says, what do I think will happen to pound news? Everything about the pound sucks. So if it doesn't fall today, it'll fall tomorrow. And if it doesn't fall tomorrow, it'll fall the next day. That's what my bias is. And why does it suck? Brexit. Are there signs of hope? Are there signs of life? Are there green shoots? Sure. But my bias is down. Pound sucks. If I don't sell it today, I'll sell it tomorrow. If I don't sell it tomorrow, I'll sell it the next day. That's my bias. Okay, so that's how I break it down, guys. Okay, so you can trade S&P 500 if you know the correlation. Now, I used to have a quant working for me. One of the greatest human beings on earth, his name was Kurt Worley. And I would say, hey, Kurt, can you download the data and get me up, current intermarket correlation statistics? And he'd say, yeah, I'd work on that over the weekend for you. Thank you, Kurt. And he'd bust it out. So it'd tell you if you were going to buy gold, if you want to buy gold, can't spell and type. If you're going to buy gold, here's gold versus all the different currency pairs. And based on what's happening now, you should probably consider Aussie Swissy, odd Swiss. That has the highest current correlation to gold, right? So it was great. Great. He could figure all that out for you. So now I'm sure if you Google it, you can find something. My style of trading as a macro trend trader. Hi, I'm Wayne, and I'm a macro trend trader. Does that sound good, by the way? You know what sounds good about it? Certainty and intent. I know what I do, and I intend on doing it. Do you ever feel like you're opening your charts and you're not sure what you're going to do? You're not sure what you're doing? You open your charts and you start looking around for something to do? That always brings up the Jim Morrison quote. Let me tell you, okay? This is how it feels when you don't know what you're doing. Again, this is a Jim Morrison poem. Let me tell you about heartache and the loss of God, wandering in hopeless night. Wow. That hit me hardest, not in its music, but I was reading his handwritten poems. He wrote that before The Doors. The Doors simply put music to Jim Morrison's poetry. Let me tell you about heartache and the loss of God. What does that mean? Like, I've been there as a trader where you're staring into the black abyss and you want to fall in and give up. Like the meaning of life. Sometimes you get that as a trader, right? Like, when you feel the market is against you, you want to do this, but it's against you. Like when you buy, it falls, and then when you sell, it rises, and right? Heartache and the loss of God. Like, and you've given up so much. Your spouse, time with your spouse, time with your kids. You could have a normal job. You could have a normal life. You give up Seinfeld reruns and you do all this homework and you work so hard and you wake up early on Monday morning to trade and you lose money and you're like, son of a bitch, right? And it just seems like everything you do, the world is out to get you, right? Wandering. Says it twice. In hopeless night. This to me represents you don't know what you're doing and you're wandering in circles through your currency charts looking for something to do. Wandering in hopeless night. Like you have no idea what's going on. Completely blind. Stumbling through the desert. Trying to find your way home. Or trying to find your way to riches. Right? So when I say, hi, my name is Wayne, I'm a macro trend trader. Oh my gosh, that feels so good. I know what I'm doing. I know what I intend to do. I know what I'm going to do. I just don't know the price and time. I'm telling you, you got to get there. I can push you, I can pull you, but you need to get to that point. So here we are planning the week. Let's go back. All right, bad news going to come out of the UK. Great, sweet. Then what? CPI out of the United States. So Tuesday is going to be a great trading day in both the European and US trading sessions. So get up early tomorrow, yo. Okay. Then what? So we got Wednesday, GDP, CPI in the European session. Very great. So German GDP, European GDP, and now you probably want the differential over that, plus CPI out of the UK. Another absolutely fantastic European session. So Tuesday and Wednesday, you got to be trading London Open faux show, or like me, Asian Open. Then what? Aussie jobs. Now, I like scalping Aussie jobs. I haven't done it in a while, to be honest, but I used to do it all the time. My famous story that I've told 100 times was hanging out at the Waldorf Astoria. And even though I live in Atlanta, I used to be able to just walk into the Waldorf Astoria, and the bartenders and stuff would say, "Wayne!" like walking into Cheers. And I swear to God, one time they pushed a tourist off the chair and wiped it off so their germs wouldn't touch me, and sat down, right? And without me asking, poured me a glass of 18-year-old Macallan, and they didn't even charge me for it. So anyway, so I love going to the Bull and Bear. So one time I'm in New York, I'm at the Bull and Bear. The Bull and Bear, by the way, is the bar in the Waldorf Astoria where like JP Morgan used to hang out and all these big shots, right? Back in the day, right? The big stock traders would all go to the Bull and Bear in Midtown. So they'd have to go from downtown to Midtown, but that's where the cool kids live, right? So anyways, so I used to like to hang out there because of the ghosts. So anyways, one time I'm at the Bull and Bear. I'm sitting at the bar, drinking my Macallan, drinking my red wine, and I'm eating through my steak. And I'm like, hey, do you mind if I just leave my stuff here? I need to leave for about 45 minutes, but I want to come back. Can you keep my steak warm? Can you? They're like, yeah, we'll take care of that. And they're like, where are you going? You got a big meeting or something? I'm like, no, Australia is about to release. And this is a true story. I swear to you. The part about pushing the tourist off, something like that happened, but I can't swear to God on that one. But something like that happened. It might have been figuratively, not literally. But anyways, so I say, I have to go. Now, this actually happened, right, for sure. I said, I have to go. Australia is about to announce their jobs report. And there's going to be a surprise. And I'm going to trade it. And they're like, really? How do you know that? I'm like, I did my homework. I'm like, okay. So you got to put this, like, I'm a kid from Saskatchewan. I'm sitting at the Bull and Bear where JP Morgan used to, right, when he bailed out the United States government. He created the Federal Reserve Bank, the central bank of the United States. This guy was a big dude, right? This is where he used to hang out. I'm just some punk kid from Saskatchewan that got into this market somehow, worked my way in. I'm sitting in JP Morgan's seat at the Bull and Bear, and I'm like, hey guys, I got to go upstairs. There's going to be a surprise announcement by Australia. I got to go make some money, but I'll be right back. So they kept my steak warm, right? I walked upstairs. All right, I was doing FX Bootcamp, so I opened up FX Bootcamp. Everyone logged into the webinar. The news came out, scalped it, went long, made enough money to pay for the hotel room, which is thousands of bucks a night, right? And then made the money, but see, on Aussie Jobs Report, I never hold on to positions. I make the money and then I get out. So I made the money, got out. Everyone high-fived each other in the webinar. Hey, it was really good. We shut it down. I went back down. They're like, how'd you go? I'm like, paid for my weekend. And they're like, well, it wasn't a weekend, but paid for my stay, paid for my trip to New York. They're like, hey, good job, buddy. I'm like, hey. So they brought the steak out nice and warm again. Another wine. And you're like, that's how you do it. Love it. That's like one of those moments when you're so proud that you're a trader, right? That you like, I don't know if you have this. I still have this, where I'm like, I'm going down an escalator or something, and I'm like, you know what? I'm a currency trader. You know, like I love it, right? Love it. So those are one of those moments you're like, that's what I am. That's what I do. And I love it. So anyways, Aussie jobs always brings fond memories for me. So again, typically if it scalps and you're up 50, 60 pips, book it and leave. Because often what I've found over the years is it comes down and then whatever. So too many times I've been up 50 and then got out at 0. Up 50, got out at 0. Up 50, got out at 0. So, you know, I don't know if it's always the right strategy, but I've learned it that way through the hard way. If I'm up 50 pips on Aussie jobs report, I put the 50 pips in my pocket and I go get another drink. Does that make sense? My pleasure, Prince. Yeah, I don't know if people, I don't know where you guys go when you're not with me. So I don't know if people share their honest, raw emotions and true history and all that kind of stuff. I don't know if it's just raw, you know, throw down a trade. I just paid for my Lambo. So I don't know what you do without me because I don't know what other people do. But so there's our week. Okay? Thursday and Friday. Great. Okay? So retail sales news on Thursday. I don't really care about Michigan sentiment. So that's our week. Of course, if you want to add the other stuff to it, you can add the medium stuff too. If you're looking for, you know, short-term volatility to get into a trade, that stuff might do it. Okay? Max, implausible. First of all, that can happen. I wouldn't risk 50 pips on a news scalp though. Because remember the way I scalp is the news comes out, so I already now know what direction the market's going. I don't buy or sell before the news. And then it comes back down and gives me a retracement. So if I bought it here and then dropped, that's not 50 pips. If I trade properly, I'm not risking 50 pips. Okay. Yeah, Prince. Because Prince, the news is not fundamentals. Okay. So if you're trading news, you're looking at. I guess I want to do this. If you're trading news, you're looking at this period here, and you're saying, well, news comes out and it could suddenly just go wham, 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 like this, right? But what that does is it impacts my 4-hour candle. So what's my trade? You can see my trade plan. Okay. So if it goes up, I'm going to sell it off the 21. I'm going to sell it off the central. I mean, I'm going to sell it. We already know that. So the news might spike this up for 2 hours, maybe 8 hours. Doesn't impact me. I'm going to be short this all week. 8 hours out of a week doesn't matter to me. So if anything, what it does is it stirs the hornet's nest and puts the market in the wrong direction. So if it goes up for 6 hours, great, it's going to push me up to my sell zone. And then I'm going to be short for 6 days. You see what I mean? There's a difference between the news and fundamentals. So this is based on the hope, or should I say bias, or should I say hypotheses, that the U.S. economy does well and oil goes up. So I know oil's not going up in the moment, so we have to analyze that to say, well, will oil go up this week? Well, those are the questions we should be asking, right? Well, technically right now the market is bearish. I understand that. In fact, we talked about that last week, and I drew this as a double bottom. Do you remember that? Because you can tell I did it over here. And then we talked about this being the monthly target. So I said, I don't know if it will, but if it does reverse, it would probably do it around here. So now to continue to go from 2 standard deviations back to the mean, which we've done, now the next thing is we got to go 2 standard deviations above the mean, which is here, which is actually our weekly target. And then next week, I don't know, maybe up again, right? But do you notice that that's where we're going? So at least if you're a bull. If you're a bear, you're going to say, no, Wayne, we're going to come back down to here. Okay, cool. Well, only a bear would think that, which is totally fine. You might be a bear, and you're just as probably right. See, right now it's 50-50. Well, actually, I'd say there's even a little more bearishness to this. So it's 60-40 bears. So if bears sell there, then they know what they're doing. If you're a bull, well, you already bought off the 2 standard deviations ago. So now you're thinking, well, this is turning bullish for fundamental reasons, not technical reasons. And so that's what you're thinking, something like that. Now, if that happens, then what happens to my USD CAD? High likelihood it goes down. Why? Higher oil prices means you need more dollars to buy oil, maybe because oil prices didn't go up, but the dollar fell. Well, then that would push USD CAD down. Cool. What if oil prices are going up because oil prices are going up because of demand, global demand? Well, then it's not necessarily a dollar play. It's the fact that the asset class is going up, and you got to buy it in Canadian dollars if you're buying it from Canada. So the demand for CAD goes up, so it's not a weak dollar, not a weak US dollar, it's a strong Canadian dollar because of actual increase in demand for the product they're selling in Canadian dollars. Or a slight combination of both. So will it do that or fall? I don't know. That's why you got to get on board. So last week I said this was my price, right? Remember plan A, plan B? And going back to then, we were talking about this being a double bottom, right? And then we found our prices, and didn't we spend a lot of time talking about double bottoms with retracements? So I don't know, right? This is what I'm hoping for this week, but I told you that last week. So if that happens, then my USD CAD falls. So now, again, we're talking about intermarket correlations, right? So I could, let's say, instead of trading oil futures, now this isn't actually a futures contract, which is great, so you can trade it, but it's basically like a currency, which is really great because you get taxed as if it's just another Forex product. You're not actually trading a futures contract through an exchange, which is that's where it gets complicated because the contracts expire and roll over and all that kind of stuff, and that gets complicated, plus then my taxes get complicated and all that kind of stuff. Okay? So this is a great way of trading it, but let's say you didn't actually want to buy oil. How could you do it through currencies? Because, oil, again, on this chart, it's like a currency, but typically, like, oil doesn't pay a dividend. It doesn't pay an interest rate. So you trade USD CAD and catch the interest rate there. But this is actually kind of interesting. I haven't done this in a while, but you can go to your, oops, I didn't. No, oh, Wayne, don't do it. I got it. There we go. Oh, here it is. Yeah, okay, so either way, there's a carrying charge. Okay, you see this? There's a carrying charge one way or the other, whether you're long or short. Okay? Normal. Absolutely normal. But let's say because of that, by the way, you can see there's a difference between long or short. You can be short-term You can be short long term, but you probably don't want to be long term. Okay, because of carrying costs. Now, really, the carrying costs don't matter, but they add up over time. But what if you were trading USD CAD? Now, right now, the differential is not that great, but let's take a look. I can't even see that. I'm sorry. Are they both negative? Might be because of the carrying cost of oil. I can't read that if that's a negative or not. If it's not negative, if it's positive, then when you're short, you're getting paid. I think that's negative. I can't see that. I need better glasses. I need my glasses. I don't know where my glasses are. But anyways, those are your carrying costs. Sometimes you might find, though, that the carrying cost on your oil position might be high, but if you traded it through USD CAD, it might pay you money instead of cost you money. So you might say you might want to do that. Okay? So hopefully that makes sense. So that's why I'm like analyzing one market, trying to catch a trade on another market. And both these moves are based on my fundamental analysis, or at least my bias. Okay. So here's euro dollar going up, and it's some people are buying, but most people are getting out of their shorts. Isn't that neat? All right. Are you a bull or a bear? Oops. So I want US dollar to be weak. Okay? You know that. I've been that way for a very long time. So I want US dollar to be weak. That's actually a good thing. Okay? And I've explained it in the past, and I'm sure I'll explain it in the future, but we don't need to do it now. Okay? Bulls buy here. Bulls buy here. Okay? That's it. If you're going to be a bear, last week here, last week here, last week here, last week here, this week here are your last chances. If we go higher than that, stop selling. Okay? For bears to be involved here, it has to do this. Okay? But this is a very specific bullish price on a monthly. This is a very specific price on a bullish weekly. Okay? Based on this entry, weekly entry, this was last week's target. We hit it in one day. Now, if you think bulls are still in this market, notice that they made a higher high. Where would they buy this week? Right here. Okay? So it's retracement and up. You got that? But it's a step up now from an M2 to a CPP. Okay, so we'll probably go to MR1 down to M3, right? MM monthly, and then probably M4. Okay, so let's plot that as a bias. Okay. La 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 la. Why did it go to 1 hour? Did I click that? Okay, so let's put this in order now. Okay. Notice how it hit the weekly target. This, by the way, predicts this line right here. I swear to you, that line predicts this line. Hey, we hit it, and it reversed. Yeah, that's what it's supposed to do. Then now we climb up on the ladder on the monthly. So where does that monthly go? So again, this is last week's. This is this week's. So what about the monthly play? And I did all these little letters and numbers. Okay. So I said probably up to R1, down to M3, up to M4. That's what I think. It's not actually what I think. It's my hypotheses. Okay? How do you check the relative strength of a currency? Well, I'm assuming you've downloaded my templates, right? So when you click things like Scan CAD, okay. This is not set up properly. Let's put it back here. Okay. So when I click on Scan CAD, this gives me Kiwi CAD, USD CAD, CAD Swissy, CAD Yen. So if CAD is strong, the top two will fall and the bottom two will rise. If CAD is weak, the top two will rise and the bottom two will fall. So let's do this again. Because of the numerator and denominator, okay, CAD is on the right, oops, CAD is on the right, CAD is on the right, CAD is on the left, CAD is on the left. So based on the relationship in these four currency pairs with the numerator denominator, if this goes up, CAD is weak. If this goes up, CAD is weak. If this goes down, CAD is weak. If this goes down, CAD is weak. So make sure you're looking at the same time frame, like all 4-hour charts, because you want to analyze over a time period. So let's get these congruent here. 4 hours, 4 hours, 4 hours, and 4 hours. Okay, very good exercise to do. And try to get the same amount of time. I don't know what's going on here. This one's having trouble. Set the template maybe. Hello? Is there a glitch somewhere? No, there's no gap. Huh. Well, I ain't never had that problem before. It won't load a 4-hour chart. Did I lose internet? No. Huh. All right. I guess we'll put these all on 1-hour charts. It's weird. I've never seen that. Ever. Interesting. All right. So now they're all on 4-hour charts. Try to make sure you got the same amount of time frame. So if you're looking at 2 weeks, look at 2 weeks. If you're looking at 2 days, look at 2 days. Right? You want apples to apples if possible. Okay, so let's go through it again. CAD has been stronger than Kiwi. So let's put it this way. So CAD is strong versus Kiwi. CAD is weak versus the US dollar. Huh, so CAD is down. That's weird. Okay. CAD is weak against the Swiss franc. CAD is weak against the yen. So CAD is weak, CAD is weak, CAD is weak. Kiwi is even weaker. Holy smokes. You see that, guys? So now we know CAD is weak. And despite that, Kiwi is even weaker because CAD is strong compared to Kiwi, and CAD sucks against everybody else. So we've learned two things, right? So we call that a relative strength exercise. And I do that probably once or twice a day. That's why I have these scan setups. I hope everyone has downloaded my chart templates. They're free. Charts.fxbootcamp.com. Okay. Relative strength. So I've given you those tools already. Now, I created something, and I'm going to give this out as a bonus. I'm just looking into the method of doing this, but I created something called a currency index. Okay. And here's CAD. Make sure it's on an hour. And look at that. This is Canadian dollar versus everything on a 1 hour chart. Generally speaking, CAD has been weak. There was a little pause, and it looks like it might get weak again. Well, that's very helpful. But my fear, the reason I've never used tools like this or never offered a tool like this before and still haven't offered a tool like this, that you're going to look at this blind, with blind faith, wandering in hopeless night. You're blind, but you think the compass is going to help you somehow. Well, if you're blind, the compass isn't going to help you. So if you don't understand what it's doing, how it's doing, I mean, you probably would use it incorrectly. You know, you got one on one time frame, another on a different time frame. You could just totally be misusing this thing. And you're relying on it as a crutch, life-saving crutch. You have no idea what it does or what it's telling you. Well, then it's false. It's a false idol, so to speak, right? It's a fool's errand. So I've never offered something like this, but I created it and people are like, oh my God, it's so wonderful. I don't understand why it's so wonderful, actually. It takes me like, I open this up and I say, oh, weak, strong. Oh, well, CAD's weak against everything, but boy, that Kiwi is ridiculously weak. Now I'm done. It takes me 1 second. 1 second. And I've given that out for years. So, but this is what people want. So yeah, maybe I'll release this as a tool you guys can have. Okay. But my fear is you're not going to use it properly. And instead of doing your job and doing your homework, you're going to look at this and it'll make decisions for you. But I want to remind you, if you ever plan on being a professional, no one wants to pay you 20% of their profits and 20% of their investment. Sorry, not 20, 2% management fee if all you're doing is having an EA make the decisions. They would rather get the EA for free or pay $50 one time for your EA and do it. They don't want to pay you 20% of the profits. So never rely on an EA to make decisions for you, because people pay you money to make decisions. How do you make decisions? You do the homework and analyze the homework, either because they're not willing to do the homework or they're not capable. They don't have your brain. They don't have your tenacity. They don't have your work ethic. They don't have your natural wit and charm. So they give you what they have because you have something they don't. You have all of that: work ethic, brain, wit, charm, right? All that kind of stuff. And they're like, well, I don't have any of that stuff, but I have a whole bunch of money. So take my money. You do all the work. And you should say, you know what? I love doing the work. Okay? So I would never use a tool like this. I might glance at it and say, oh, that's interesting, and then go take a look. But I would never use it to do the job because I want to do the job. I'm not looking to cut corners. But generally speaking, pound looks weak, Kiwi looks weak. Really? Euro looks strong. But we already knew this. Aussie looks weak. Wow, newsflash, right? What about CAD? Pretty neutral. What about Swissy? Fairly neutral. What about dollar? Weak. What about yen? Well, this actually should be inverted. That's strong. So you got to be careful there. Unless, hang on, let's double check all that. Sorry, I went to an 80s concert on the weekend. Sorry. Manipur says, my trading performance has improved a lot. Thank you, Wayne. No, thank you. Yeah, so that yen one is not calculating it properly. I'll have to look at what it's doing wrong. Cool. So yen is strong. Yen pairs are down. And again, maybe that's why you don't use a tool like that. Because I can look at it and say, no, that's not right. Well, what if you didn't know? All right. So this is a problem, right? Notice we're below the 21 on everything. If you've read my book, or if you've done any of the free training courses, you'll know that if you're below the 21, you're bearish and aggressive. Alejandro says, Euro yen double bottom, maybe? Don't even think that way. You're right, it might be. Don't even think it. Don't even think it. Do not pick a bottom. Okay? I want you to think this way, Alejandro. Okay? If you want it to go up, that's cool, but maybe here. And for sure here. But don't do this. Don't do this. Do not buy it because you're at a double bottom. Do not buy it because you're at an S2. Buy it because you want to be a bull and it's given you a reversal pattern at very obvious support. Don't trade the double bottom. Okay? Trade the 1, 2, 3. 1 is only the double bottom. By the way, at obvious support. If you're not at hardcore obvious support like a monthly S2, it's probably not a double bottom. You're not seeing it right. 2, higher high. In this case, I didn't even give you a real higher high. I just went from a breach to 21 to a 55. And then 3, you need a higher low. So even what I drew you isn't even a proper 1, 2, 3, but it's something. And again, this is a maybe, this is a for sure, this is a don't do it. Don't do it. Okay, don't do it. Okay, just don't do it. You don't need it. Walk away, man. Walk away. Don't worry. Don't worry about it. Don't worry about it. Oh, but what if it got? Don't worry about it, man. Just shh, shh, shh. Ask yourself, what does it do? Are you a trader? Sounds really good, right? You look for trades? You know what? I coined something a long time ago. I said, you're not a trader, you're a profiteer. Okay? You're not looking for a trade. Is a double bottom a legit trade? Totally legit. I'm not a trader. Okay? I want to make money. Okay? So if I can catch something like this, I have a lot less risk and almost the same amount of profit potential. And then I'll catch the next one. Then I'll catch the next one, right? And ideally, I get a trend. So if this is a downtrend, oh my gosh, I'd much rather be selling this than buying it. Okay? So one thing I've taught myself is trends will fall forever. You know how they say trends are your friends until they end? They never end. They never, ever end. I would rather teach you that a trend never ends than say, hey, you can get rich by, getting the exact bottom. You don't want the exact bottom. So I'd rather you say, this is going to fall forever, but if it does this, get out. Or if this is going to rise forever, but if it does that, get out. That's what I'd rather teach you. Why would I rather teach you that? Hi, my name is Wayne. I'm a macro trend trader. I trade along with central banks based on what's happening in the global economy. Think about that. Hi, I'm Wayne. I'm a macro trend trader. I trade along with the central banks based on global economics. Yeah, Oscar says, Wayne, can you talk about trading psychology, about scaling up, going from 100,000 to 5 million and all that kind of stuff? The key thing to all of that is trading everything in percentage, not lot size. So one thing I've recommended over the years is, let's say, I don't want to give a percent as a number because it's not the right thing, but let's say one standard lot is equal to 1% of your account. I would have you trade mini lots. So you might start with 2 mini lots. So you're 0.2%. Every trade is 0.2. So if you make 5 trades that day and they're all open, they equal 1% of your account. All 5 trades. Okay? So you get this 0.2 thing going, and then your account size gets bigger and bigger as you make money. You're still trading the 2 mini lots. Okay? And you keep trading the 2 mini lots. You get to a point where the 2 mini lots now, as a percentage base, the 2 mini lots, or let's say the per trade, because the account size is growing, but you keep it at 2 mini lots, at some point, 2 mini lots only equals 0.1% because you have more money in your account. So you keep trading the same lot size, but as a percentage, your risk is now half. Okay? And you can play this game and drag it out as long as possible. Keep growing your trading account. But then you get to a point where it's even dropping less than 0.1, and you'll say, okay, this is ridiculous. I'm going to move it back up. So let's say you've come out of the summer, you're expecting some good trading to happen, and you're doing your homework and all that kind of stuff. You say, well, I want to go in and I want to get, let's say this drops back to now 0.05 because 2 mini lots is so small because you, as a percent of your actual account, because your account is getting bigger. So you say, okay, I'm going to bump this up, and I'm going to bump it back up to 0.2 because you like to start every January and every September at 0.2. So now let's say you got to go from 2 mini lots to 5 mini lots. And now it gets back up to the 0.2. And you trade the 5 mini lots, you do it all the way to the end of the year, and you've grown your account, and it's now your account gets you back to the 0.05% if you continue trading minis. So you go on holidays and all that kind of stuff, and you come back the first week of January, and now you got to trade to get back to the 0.2 level of risk. You got to trade now a full standard lot. And you do that, and you slowly grow your trading account. 6 months go by, and now you're back below the 0.1. So now you got to, through summer you might keep it at that one standard lot, but it only represents 0.1, right, percent per trade. And then you go all the way through summer. You find a way to not lose money, and that was really good, right? And you might be trading 1.2 now, and by the end of that period, you might be trading 1.5 or even 2.0, and you just keep doing that, and you keep lowering, okay? And so what happens? This goes back to the question, how do you deal psychologically with scaling up? You scale up on that percentage. So you're trading per trade, you might only be risking somewhere between 0.2% and 0.05%. And that you increase your lot size, not based on how you feel and all that kind of stuff, but you increase your lot size based on how much you've grown your account size. So now you can say, well, I'm not risking enough to fully leverage my capital. You're right. So now you move it back to a 0.2 risk by increasing your lot size. And now you're back to where you were. You might be trading twice as much lot size wise, but you go right back to where you were mentally, and you say, oh, well, I'm back at the -2. So every time I make 5 trades, right, every time you make you have 5 open trades today, and all 5 lose, you know that you've lost 1% of your account. And you're like, you know what, that was a horrible day. How could I make 5 bad trades in a row? But things went wrong, horribly, horribly wrong. So you lost 1%, and you cry about it for a day, and then you come back. Okay? Does that make sense, guys? So when you're trading, $1 million lot sizes and you're making 5 million a day in volume, it's only 0.2. Okay? And trust me, this is what I do. Okay? I've traded almost $1 billion a month, but never faced anything risky, or try not to face anything risky. Okay? If you don't do it this way, here's what typically happens. You freak out. I've seen this, I don't know, 100 times. And not just by like boot campers, but I spent a couple of years looking at other traders and hiring them as money managers and stuff like that. And I've analyzed, I'm sure 1 million trades and thousands of, quote unquote professional traders. And it's amazing how you get them into a run and I guess I should do it the other way. They get in a run like this for a year or 2 or 3, and then it just goes like this. And I think what happens is they get here too quick and the money becomes a problem because they're thinking about it in terms of money and not in terms of risk. There's fundamental is not the right word, but let's say psychological. There's a giant psychological difference between 2 traders. One is thinking about money and the other one's thinking about risk. Okay. And the person that has gone from a mini lot to a standard lot to 5 standard lots, but is thinking about it risk-wise and understands there's no difference, they're not worried about it at all. They're just not worried about it. Someone else is focused on money and they have a bad day or something and they lost, like I've told you this story too in the past, but I was analyzing this guy's trader and he sent me his live account details. I actually logged into his account. And he had lost $20 million in 3 weeks. And I said, this is terrible. Walk me through, what were you thinking as it kept falling, you kept buying? And he's saying, he's like, it was only 20 mil. So his investor asked me to meet with him to talk about his trading and stuff. So anyway, so I log into his live account. We're talking about it. And he's like, wow, it was only 20 million. I'm like, well, explain that. He's like, well, as you can see, I got a couple $100 million into this account. And he's like, but that's just the play money. He's like, the real money is in a different account. And this is, they're not directly tied, but I'm supposed to think of it as a percentage of that. So, if you have, let's say, $2 billion and you lost 20 million in the last couple of weeks, well, it's only 20 million. I said, well, that's not, I see what you're doing. Maybe it's a small percentage, but you have a problem if you keep buying something that looks like that. So we have to work on that. So it really depends. The problem is, what if you're thinking about it and 20 million is a lot? It's the opposite. You can lull yourself into terrible scenarios. But anyway, so it was pretty funny. He's like, yeah, it was only 20 million. I'm like, well, your investor doesn't think of it that way. So I think that trader is buried in the sand somewhere between Abu Dhabi and Dubai. If you guys know that gas station halfway between those two cities, and you can buy gas and also like go falconry. You can rent a falcon, right? You know that place? If you just go on the other side of the Doom Buggy rental area, yeah, he's buried over there somewhere. So if you know the area, you know where he is. All right. So that, I would say that's too laissez-faire. All right. What time is it? Have I gone too long? I've gone too long, haven't I? Yeah, I apologize. I guess we got, we did the COT, we did the calendar, we did CAD, we did the yens, we did some dollar, we did oil. I don't think we did gold and stuff, but I guess we'll just pick up. I don't want to go too long, unless you guys want me to stay. I don't know. I don't know if I don't know if you got other things to do and stuff. Let me know. Should I stay or should I go? Seriously. All right. Well, let's say there's well over 100 people. There's over 150 people. If there's more than 100 thumbs up, I'll stay. I just came up with this idea. This isn't my plan. If there's more than 100 thumbs up, I'll put in another half an hour or so. We'll go through gold, for example. So let me find the video. So if there's more than 100 thumbs up, I'll stay. If not, I'll pull the plug. Because if no one cares, nobody cares, right? So youtube.com/Forex.Today. Here we go. Let me pull it up. Yeah, I'll do gold for sure. I haven't done it yet. So 146 watching and only 82 thumbs up. So not good so far. .com/Forex.Today. So, oh wait. Oh, 98. Oh! 101, baby. All right, thank you. Woo! Thanks. Oh, wait, but there's one thumbs down, so there's only 100. I said more than 100. We need 102. That was pretty cool. Right on. Okay, cool. Thank you. Hey, man, I'm an only child, so I feel great when people share love. Like, oh my God, they want me to stay. I'm so happy. I'm happy. Thank you, guys. All right, let us dive into here. Let's do some gold. Wow, I'm so happy. You just made my day. Like the butcher, the baker, the candlestick maker. Nice. Gold. Here we go. Do some gold. All right. Well, do you have a plan for the month? What was our plan, guys? Do you remember? I'll draw it. We had a high here going back a month, right? Do you remember? We made a higher high, so I drew it out like this. Okay? That's what we had. And maybe it still exists on a different chart, but that's what we had. So I have to tell you that because it's going to be in the back of my mind, right? So we had it like this. Okay? Sure what I'm talking about? That's how we had it. That wasn't perfect, but that's how we had it. And we had a breakout, pullback, long and gone. Now, on a monthly trade plan, if you're a swing trader, This is like a slap in the face obvious. And here is the target. And we knew that on the first day of the month. So here we are, we're above that. So what do? I try to ride the 21 and I cannot sell. So I either buy dips or I don't trade. Because remember, this is supposed to be where you take profit. So technically, you're not even supposed to be in the trade anymore. You should just be spending the money. The money should be in the bank, and you're like, oh, it went a little higher. You're like, yeah, too bad, so sad. Okay. So now the only thing we have, well, there's two things we have. We have the dynamic support. And that is the 21. Ciao. Now we have market support. But that's a little lower than where we are now. That's down here. So that's not in play. So we call this an out of position. Oh, Pete, yeah, you know me. Okay. Out of position trade. So you kick off the 4-hour 21. You're probably going to hit the weekly target early, and then that sets us up for a counter trend. Once again, this is all out of the swing trading course. And, so my goal is to build the swing trading program this week, and we need to start very soon. So not this Friday, next Friday. So if you're still taking the swing trading course, you need to complete it in order to get an invitation to join the trading group with me. Okay? So I'm just letting you know. Okay? So, going back to this. In this situation, we have an OOP. A target will probably hit here early in the week. And if we do, get prepared for a counter trend and the rest of the week probably down. Yeah, if you guys have a blurry video, you need to go to your YouTube settings at the bottom of the video and change the, do I still have it running somewhere? So change it here. So I'm broadcasting in HD, and you can change it maybe to something else, and it should unblur it, and then maybe change it back. Okay. By the way, lots of new viewers here today. So once again, youtube.com/fxbootcamp. I should probably just save the link. Too old for that nonsense. Like if you're wondering what are my moving averages, what are, all of that is answered for you and free. So you watch this playlist. Here you go. And that's about 1 hour. That's about 80 minutes, about an hour and a half worth of training. It goes over all my chart setups and how I use them, my trading strategy and stuff. And I've been trading that way, I don't know, for 13 years. I haven't, at least 13 years. It's been documented. My style of trading, my method of trading, I've been sharing with people for 13 years. Okay? So imagine for at least 13 years, that's how I've been trading. So I'll teach you. And what does that mean? There's 1,000 different ways that don't work. So you have to trust that I worked very hard for a very long time to find many, 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 many ways that don't work. And over, let's say, the better part of 20 years, I found a few things that do work well. And I haven't changed since, because there's never been a need to change, ever. So, compliments of the firm. So like watching those free videos and downloading my chart templates, probably 5 years, maybe 6, I'd say closer to 6 years of night and day work, full-time job, night and day. I'd say 12-hour days minimum for 6 years it took me to get to that point. Now you can just download it for free, watch it in 80, 90 minutes, and you're on board. Plus, I'm here every day for you for free. Okay? Cool. So let's go back to that gold. So here's that scenario of gold where you ride it to here and maybe counter trend it down, or ride it from here and take profit, or don't buy it. You are not allowed to sell it unless it counter trends off of this area here. Okay? But what I teach in the training course is this is an obvious buy. We call it an OOP, out of position, up into here. If you hit it early, then it's going to counter trend probably back to here. Okay? So I could see at least 2 trades going on there. fxbootcamp.com. Pretty simple, fxbootcamp.com. Cool. Gold. So that CAD's looking good now. Thank you. USD showing some weakness versus the Swissy. So I don't typically trade this, but I like that because that gives me my dollar weakness. Euro dollar. Yeah, I'm just waiting. Remember? Do you guys remember that plan? I'll draw it just in case you guys forget. See, the wonderful thing about technical analysis is like I don't have to remember what I told you because I'm just reading the charts. So like if you cannot memorize the entire Bible or the Quran, I've read the Quran, by the way, and many of the Hadith. I certainly can't memorize it, right? Especially a lot of it in different languages, right? So I can try to remember the Quran, you know, Allah Akbar, God is great, God in the highest, the Almighty God, the creator of the universe, God, right? And then so on and so forth. I'm like, well, I can't remember that because it gets tricky, especially if there's words I'm not familiar with and people I'm not familiar with. Nor could I remember the word for word the Bible or you know, the Old Testament, so on and so forth, right? Like I can't memorize anything. Let's put it that way. In fact, my brain doesn't work that way. I cannot memorize anything. But the nice thing is if you speak the written English language, you can open up the book and read it and get it right every single time. You can read the entire Bible, front page to back page, and then open the Quran and the Hadith, right? And the Torah and the Bhagavad Gita, right? Read the Gita word for word. I have actually. I have the English, Hindi, Sanskrit version of the Bhagavad Gita, right? I don't have to remember anything. I can just read the words and understand what they mean. So in this case, technical analysis is just a language. So I look at this, every time I look at it, it says the same thing. Probably up here, if we can get higher than that, right? Every single time I look at it again, I'm like, oh, well, So higher, low, up into here, and then we'll probably take a break, and then maybe up into here. Every time, over and over and over and over and over and over and over. It's not opinion. I didn't read. I didn't write, you know, the hadith. Right? I did not witness Muhammad speaking to his people. That's what the hadith is. Eyewitnesses and eye accounts of what he said and did. Great. I wasn't there, but I can read the book. Right? Cool. So this is the same thing. I didn't write this. I didn't make it up. I don't want it. You know, I do want this to go up, actually. But I didn't make any of it. It's just, this is it, and this is the analysis, and it is every time I look at it, it's going to say the same thing. Not an opinion at all. And this is what you want. This is where you want to get, where it's just what it says, and it doesn't say anything else. Now, there's a lot of I guess there's a lot of interpretation. And again, if you read the hadith, there's lots of different interpretations of what was said and done. That's different schools of thought, right? So what's your school of thought here if you're an Elliott wave trader, if you're a counter trend trader, if you're a swing trader, if you're a scalper? There's all different interpretations of what to do next, or in fact, not to do next, what's going to happen next is really the question, right? So some people will say it's going to do this. That might be my interpretation. Okay? But of course, other people might have different interpretations of what's going to happen next. And so when I say euro dollar is going to do this and do that and do that and do that, well, that there is some interpretation to that. I am using pivot points. Not everyone uses pivot points. And I am using price action. Not everyone uses price action. I am using Fibonacci. Not everyone uses Fibonacci. But I'll show you why trend trading very often works. Because you can be an Elliott wave trader, and I'm not an Elliott wave trader. But the vast majority of what I do, they would do too. For much of the same reason. I like Fibonacci. Elliott wave guys like Fibonacci, for example, right? They don't use pivot points, but there's a reason. Like, what do pivot points tell you? Up, 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 down, down, buy. Up, 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 down, down, buy, right? Let's do it that way. If you're a downtrend, what do pivot points tell you? Right? Down, 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 up, up, sell. Down, 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 up, up, sell. Well, if you're a price action trader, what does it tell you? Right? Down, 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 roll reversal, sell. Down, 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 roll reversal, sell. Right? Not to the degree of accuracy that I prefer, but it tells you that thing, right? Down, 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 up, up, sell. Down, 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 up, up, sell. Okay, so we got pivot points, we got price action. What do the moving averages tell me? Right? Sell, take profit, sell, take profit, sell, probably take profit, right? So on and so forth. So I can use moving averages and all that kind of stuff. You might do an Elliott wave thing, right? And we all end up kind of doing the same thing for the same reasons, or for slightly different reasons, or, you know, instead of even using pivot points, you use Fibonacci. Sweet. Great. I would agree with that. Pivot points would probably agree with that. Elliott wave people would agree with that. There's probably a lot of other people too that would also agree with that, for slightly different or maybe exactly the same or even totally different reasons, but everyone ends up doing the same thing. Pound dollar? Sure. Pig dog, pig dog, pig dog, pig dog. Let's do some pig dog. The great big pig. I wake up in the morning and it's 1:45. What do? You sell the pound. You sell the pound. Yeah. I'm not joking. Okay, are you a bull or a bear? Yeah, TBM most likely, or you. That's why I use monthly on top of that. So I start with a monthly plan, and then I do a weekly plan, then I do a daily plan. And I got to follow up with my programmer to see how he's doing on your daily planner. But anyways, so I'd be a bear on this. That's all. Okay. So I'm going to sell somewhere in here. Done. Next. So that would look like something like this. Okay. Done. Neat little scalp zone too. Okay, so I'm in my sell zone. What would it take to get you to sell this now? How would you feel if the if the 2155 crossed down and you found price? Let me do price in black now. And you found price doing this. How'd you feel about that being right here? I know you can barely see it. I can barely see it. How'd you feel about that? It showed weeks back? Oh, well, yeah, change the settings. Hang on. So you do this, indicator, right? So I think what you're saying is your pivots look like this. And you're probably on a weird time frame too. So you're probably like that. But you're probably on a... No. Does it look like that? If so, you got two things. You're on a weird time frame. I like to look at it like that. And if you don't like to look back more than 1 week, change it here. And you're done. Now you only have this week. Okay? Oh, then if it's not that, I don't know what's going on. I don't know if you use my templates. I don't know if you've changed my indicator. I don't know what kind of account you have. I don't know if you stalled my MT4 charts into MT5. But yeah, I'm sorry. I can give it to you. So that's what I'd be thinking about. So I'd go back to a 5-minute chart. And I'd say, I want to sell, I want to sell. Do I want to sell this? No. What would make this bearish is another way. So I showed you with moving averages what might make it bearish. Well, what if you were lower than this? So I'd mark that too. Would you trade a lower high? Would that change your opinion, maybe? Well, this is a 5-minute chart, and this whole area, that is our predicted resistance based on a 4-hour high, 4-hour 21 EMA. So we can do it like this. Four-hour 21 EMA resistance. Resistance. Is it resistance or resistance? Anyways. So I would leave a note for myself if I wasn't sure. Now I'm in scalping mode. Oh! And the indicator did, so you don't have it installed properly. So anyways. Does that make sense? Now, I looked at it on a 4-hour, and I know I want to sell here. That's why I made this purple zone, to remind myself I want to sell here. And now I'm using technical analysis to confirm or deny my hypotheses, not on a 4-hour chart, because I don't want to wait 24 hours to get a crossover. So I'm going to wait for a sign of a change in trend on a 5-minute chart, knowing I'm at the right price. I don't know if this is the right time. I know I'm at the right price. You see that? What price do you want to sell pound dollar? This price. Okay? Is this the right time? Well, that's why I'm on the 5-minute chart. I need technical analysis to tell me when it's the right time to sell. Okay? So I could be super aggressive and take a 5A cross down, but that didn't work here and it didn't work here. I can be a little, or I can wait for a low lower than this or a low lower than this, or I can wait for a 5A cross down. If I use an oscillator, I can try to change a high side cycle. So I can do oscillators, stochastic oscillators. Oh, where is it? Oh, at the top. I thought it was on the bottom. Colors 835. Okay. So if I'm at resistance and it's overbought, I might sell it using an oscillator. Okay. Whatever tool you want, it don't matter none. Okay. You might say, well, I don't want to trade price. I want to trade when the 5-minute market, if there is such a thing, right? I want to trade when the 5-minute market turns bearish based on my hypotheses on a 4-hour market. So in that case, I don't know if this one has, well, obviously it has the right MACD somewhere. I think it's a custom one though, isn't it? Adding it. Forget which one it uses. No. Because I use a custom MACD, don't I? Let's do this a different way. Let's add my template here and find out what I use. Yeah, MACD Osama. But it's not, it doesn't remember it, so I'll have to deal with that later. But anyways, you can use a MACD crossover, for example. So I can move this to a 5-minute and trade MACD. And of course, I would do it like this. You'd probably get MACD divergence first. So this makes a high, this does not make a high. So then it would come up and come down. Okay? So I'm still waiting for my trigger. I have my right price. I know my price. What does that say? 121? Okay. So I know my price is sell at 121. We're at 120.95 and a half, 96 and a half. Okay. La da da ba 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 da ba da ba ba do do do. Okay. So I've added a little scalping tool. And the scalping tool, let me move some of this. Can't move the watermark. Let me get rid of this though. We know that that's plan A. Oops. Cool. So I got this little scalping tool. I don't know if you want to check that out. So I set it, and you can see it's running here. I set it. Let me do it this way. It's not going to show you easier. I set it so that if I sell, it's going to put a 15 pip stop loss above price and a 15 pip limit order below price. It's called a 15-15 OCO. Now I can change it to whatever I want. I could do a 1530, I could do a 2020, 2525, 2050, 3399. Okay, but it automatically does things. So let me show you. Let's say I sell here. Now it's a bit early actually, but I just want to show you this. Oops. Okay, I want to show you just how it works. Okay, oops. So let's say I sell here. Boom. You see? I put a stop here and a limit here, and I didn't do anything. See how fast that was? Done. So if I'm scalping like, let's say 5 or 6 currencies at a time, it's a set it and forget it scenario. If I'm doing swing trading, I wouldn't use a 15 pip stop. I might use a 33 or a 55. 99. Okay. So this is a bit early. I'd rather be selling lower on a retracement. I just want to show you how it works because I don't want to sit here. We've been going well over 2 hours. I just want to show you how the scalping tool works, right? It's all set it, forget it. I don't have to do any calculations. Every time I pull the trigger, it'll do it. Ciao, done. And then, of course, I can drag and drop and move them, right? So I'm like, you couldn't, why would I only want 15 pips, right? So I can drag and move my limit. Or if I'm getting nervous, I'm like, oh, I'm going to move my limit closer. Okay? Cool. Or I can move it here and say, I don't need a 15 pip stop. I'll move it to 8. So now I got like an 820. Isn't that cool? So like, maybe it's not that cool, but trust me, if you're doing 5 or 6 or 7 or 8 trades on different currency pairs, so you go pa-chow, and then you move over to this next one, and for 15 or 20 minutes you go pa-chow, and then for the next 15 or 20 minutes you're doing this other one pa-chow, and then you hear this, and you look over and you're like, oh, I caught my first short, and finally get paid on that one, but you're not watching it. If you ever find that you're staring at your trades, you're doing something wrong, right? You shouldn't be staring at your trades. You should be looking for the next trade. Does that make sense? Is that neat? And then, of course, so if it hits this one, you get taken out for profit, and this one's canceled and removed from the market. If this one gets hit, you get taken out for a loss, but this one's canceled. And then, of course, you can take profit on both if you want, right? And you can just close it. Look, and I just made money. Yay! And I can do that. Very, very easy. Very, very, very easy. Now, a lot of you guys might be doing this. You're like, okay, new order. And there's the price, and then I'm going to sell there, and then I need to do a stop loss, and then I'm going to calculate that, and then I'm going to do a take profit, and then I'm going to calculate that, and then I'm going to... No, that's what I was supposed to give. So the new one is in there, TBM. Yeah. Yeah. So, but I'm redoing everything, TBM. So if you have the old version, say I accidentally grabbed the wrong one. I don't know where it came from, but it just arrived one day when I was creating it. I saw this thing called an OCO, which is one console's other, which I just showed you. But then what I was supposed to give you was auto stop. So I'll give that to you guys as well. So I'm redoing everything this week for you. So imagine, you're having a day, or how about this? This is something that happens a lot. What if the markets are crazy, right? Like, I don't know if you've seen a crazy market yet, but they get crazy from time to time. I've had it where I've had it where, you'll get like 75 pip candles, okay? And then it comes up and up and up, and then it goes boom. Another 75 pips. So in the course of an hour, it's moved 150 pips, right? I've actually done it where it's moved that much in 12 minutes, but I'll give you an example of that. So often what I'll do in that scenario is I'll use the OCOs and I'll say, okay, I can see we're moving 75, so I don't want to risk more than 33 on my entry. Okay. And I want to go for 99 because when we get down to this, I'll make a decision whether it's going to go a little further or if it's going to back off. And usually that has to do with pivots and cycle levels and stuff. So, you know my style of trading, right? So this will be, a big red candle. And I'm not on. Let's say I'm trying to get in. And then it goes green, green, green. So now I'm thinking about it. Now I want to sell. I'm thinking about selling. I'm waiting for it. And it starts to do this. So then I throw down my OCO. So I get here and it goes 33.99 and I'm in. So in that scenario, if it goes from turning red to suddenly green, green, green again, oh, snap. Well, that's like a 72% retracement of, right? Or a 786 retracement of the bearish engulfing. Not likely to happen, but if it does, I definitely want to be out. And I had an opportunity, and I risked 33 pips, and I paid for the opportunity, but it's not a big deal. But it's not likely to reverse after a bearish engulfing candle, especially if I waited for the retracement, right? So now I'm really only risking the difference between, let's say, a 62 and a 7.8, right? It's not that many pips, but it's 33 pips. But if I get it right and it does turn bearish again, and if you're a trend trader, it's supposed to turn, right? You might get a giant bearish engulfing candle again, or a series of 3 smaller bearish candles, but I'm going for the 99. And then once I get down here, I might find my 99 is 10 pips below a psych level, so I might move it up and move it to an 88, okay? And I can adjust and stuff, but I can do it very quickly without thinking, because in these types of markets, you wait for 45 minutes and then it drops very quick. Tsunami style, right? Pachow. And it's just gone, and you're in, and then you very quickly move your stop from negative 33 to negative 3. So now I'm doing a negative 3 88 plus 88, and that's called OCO. Okay. You guys might have seen me on Bloomberg. I did this neat thing. I did it 2 years with Bloomberg. It was called The Educated Investor. And in this particular time, we're in the offices, and all the walls at Bloomberg, they're glass. And there's all kinds of people working, and there's people walking around. We set up sort of in a corner, but in the open area, employees walking around and stuff. And there's a producer, a cameraman, and some sort of assistant. We go into the corner, and they're like, okay, your tie looks good, the lighting's great, the sound's fine, great. And then you say, okay, well, we're going to ask you questions about currency trading. I'm like, cool, right on. They turn the camera on, 3, 2. And the producer says, tell me about the Japanese housewife. Tell me about risk. Tell me about a pip. Tell me about stop losses. Tell me about, right? It's just like, we went for a long time. My calves were cramping because I'm in my $1,000 shoes. And of course, they're the most uncomfortable shoes in the world. So I'm starting to get leg cramps for standing there so long. One of the questions they asked me about risks and stop loss. So I started actually teaching a little bit. And I said, well, stops are very important. You got to manage risk, and risk is all blah, 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 blah. And I said, actually, when I trade, I have 2 stop losses, one for a loss and one for a profit. We call this an OCO order, or one cancels the other. And then we go through it, right? And that was one of the 5 or 6 different things they put on TV. Was me explaining, because they're very worried about risk, right? So Bloomberg did this series, The Educated Investor, and one of the 5 videos was me talking about risk. I'm proud of that. Like I get to talk about risk. That's really cool. And they invited me back the second year to speak again. And I was the only person they asked back for the second year. It's really cool. And they did that for 2 years. It was really neat. OCO. So I don't know if it's on Bloomberg anymore, but I have it somewhere. La 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 la. I don't think it's here. Oops, I'm gonna turn that off. I don't think it's here anymore. It's so old. Bloomberg educated risk. There's no way it's going to be here. It's too long. Forex volatility, no. Bloomberg. Oh, is this it?
The Investor is brought to you by DBFX.
There's so many of them.
Bank.
Looks like 2012.
Trading currencies, like many investments, can be risky business. The 24-hour-a-day market is highly speculative and extremely volatile, so you'll need to have a trading plan in place before you begin.
There's no 4 o'clock close. I need to realize that price action will continue on beyond in a 24-hour fashion, so let me understand and learn the tools that are there, like orders.
When you put in an order, the way that you manage your risk is by using stop losses and limit orders. You put in a stop order that says if things go bad, if your analysis was wrong and you start to lose money at a certain point, when that stop loss order is triggered, you're taken out of the market before things get worse.
Then there are limit orders that protect you when you're making money on the trade. They are also called take profit orders.
A lot of times what people will do is that they'll see their position move in their favor, and then they'll let it completely reverse against them.
McDonald protects his trades using both tools, and when one is triggered, it cancels the other. It's called an OCO order.
When I place an order, I actually place 2 different orders, a stop loss to protect me from the downside and a limit order to where my profit target is.
Another phrase in the language of FX is being stopped out.
Let's say you want to go long, you're buying, the market turns sour on you, you're losing money. You have a stop loss order in place to protect your downside. When that stop loss is hit, you're stopped out.
With a proper risk plan in place, you have a better chance of surviving losing trades and profiting when you make winning ones. Thanks for watching Bloomberg, The Educated Investor. I'm Carol Dion.
So what was it, 7 years ago?
Bloomberg Educated Investor.
That was when Kathy Lean worked for GFT. Back then, I had my own dealing desk at GFT. All they did was service my trades. By the way, we just got knocked out on our OCO. That was our target, wasn't it? Beep, beep, beep. Easy scalp, man. Scalping's so easy. When the fish are jumping in the canoe, get a bigger canoe. Anyways, so that was real. That was a day. That was a real good day. Thank you for being in my life. I hope you had a wonderful weekend and a good start to your trading week. Lots going on. It's going to be good. Remember, Tuesday and Wednesday is going to really be good in the European session. Make sure you're there. Keep your powder dry. Thank you for all the great questions. Thank you for the thumbs up. Thank you for leaving comments. If you're watching a recording of this video, please leave a comment. Subscribe to the channel. If you're not getting alerts properly from YouTube, you can also go to twitter.com/FXBootcamp. I do send out tweets when I start the webinar and when recordings are available. And yeah, make sure you go to tradersway.com and open an account today. And if you want my chart templates, my moving averages, my profiles, my pivot points, both weekly and monthly and daily, if you want all of that, it's totally free. Thank you very much, Traders Way. Visit charts.fxbootcamp.com and it is yours. So have a wonderful rest of the day, and I will see you tomorrow. Peace on earth. May the pips